Basant, thanks so much for taking the time out and joining us today. I'm starting off, actually let's start off with your thoughts on the markets first before I move on to some very interesting tweets that you gave out on October 3rd. Firstly, is this a good time to be investing? People can take their choices of where to invest in. Is it a good time to invest, or would you believe people should keep some gunpowder dry?
Good to be with you, Niraj, again. So I think it's not about the time to invest. What's more important is what you're investing in. So if you're investing in the wrong stocks, so no time is good. If you're investing in the right stocks, any time is good time. So eternally we are born bulls, so the blood of a bull runs inside us. So we are always fully invested, and we don't keep gunpowder dry because we are so bullish about what we own. So we get it wrong and we get it right. That's another issue altogether. But I think if the companies that we have bought, if they are going to grow, if they're going to show earnings growth, any time is a good time to invest. And we are completely invested. But overall, if you ask me, the red flags in the economy, I mean, of course, everybody's talking about that. But what you have to understand is 2019 is election year and 2018 is pre-election year. So if you're a farmer, I think you should celebrate the next 18 months. But if you're not a farmer, if you're an investor, if you're a middle-class guy, I think you have to, deal with the ball again. So it's going to swing around a lot of it. So you just keep your wickets intact and play safely. That's what I can say.
So what, try and buy into companies which will benefit as a result of higher farm income, Basant?
No, not that. I mean, I don't think the government, whatever reforms it had to do, it has done the reforms. And that's, I think, two reforms which the government says it has done. One is demonetization. It was not a reform. It was basically a surprise or a shock to everybody. So none of the brokerages, none of the market participants expected demonetization to be a reform. So it was an action which is now being sold as a reform, if you ask me. And the second is the GST. GST is an old thing. We've been talking about GST for almost a decade now. So I don't think anything new is going to come for the stock market as such. And whatever things come, it could only be populist in some way. So because of that, and because of the fact that a major section of your market isn't able to stand on its feet, and let me give you an example. IT is in a limbo. Pharma, there's a problem. PSU banks, I mean, if you recover the old money first, then you go and lend to the new guys. So 3 sectors out of your entire investing horizon is under a problem. So what's left with? Private financials, a few auto companies, auto ancillaries, the odd textile company, and some company. So the choice was limited, and I assume it's going to stay limited. So, but if you're a stock picker, you need 3, 4, 5, 7, 10 companies to put your money in. You don't need 50 companies. 50 companies are for the index fund. So you just zero down on your 5, 7, 10 companies, and then you say, okay, that's the way it should be. So this is what we are doing right now. And this is what we have done all the time.
That's really the problem, because, a few stocks which are left where you don't see any major issue, the stocks you have been liking, you still have a conviction buy on these stocks, but the valuations have moved from expensive to highly expensive to historically all-time expensive zones. A true investor like you, a long-term investor like you, how do you really react to this scenario?
Let me give you a different view to this thing. So, if you and your friend are being chased by a tiger, you don't have to run faster than the tiger. You have to run faster than your friend. So how do we put that in the market? So if there are 50 companies growing at 30%, so all those 50 companies, so investors are splitting their money across the 50 companies. So if there are 10 companies growing at 30%, then the investors' money chases those 10 companies. So all throughout the 300-year history of stock markets, money, liquidity has chased growth. And that's what it always does. So I'm not trying to, let's take the case of the new issue which got listed. You don't own it, just not a recommendation. I'm just discussing it just for the sake of a discussion. Pratap Snacks, I think it's called. Trades at 40 times FY20 with less than 5% net margin. So it says you're going to improve margin and do this and do that. So 40 times FY20 for a Pratap Snacks. I mean, you can say it's expensive. I thought it was expensive at 900. So it went up 20%. So, I mean, in the market, it's not about valuations all the time. It's about how many companies are able to grow at that rate. So if the number of companies that are able to grow at that rate reduces, obviously the money that chases those companies obviously creates a more bigger impact. So I think that's the way to be it. But of course, I'd like to buy them cheaper. But if you don't buy them cheaper, then what do? You buy them, and if the growth is predictable, sustainable, and sure, then you assume, okay, I won't make money for 1 year, I won't make money for 9 months, but the incremental earnings growth is going to reduce the valuations for me. But for that, you have to be very sure of what you're buying. And if you are sure about what you're buying, then you might say, okay, I won't make money for 8 months, for 9 months, for 1 year, in the worst case scenario. But if the growth is predictable, the stocks automatically get cheaper with each passing quarter. So that's how we are playing the game.
Basant, let's talk about a couple of pockets since you're talking about newly listed spaces. Insurance, I'm looking at the tweet that you gave out. Spending a lot of time first, then making profits. A great rocket to be in after it leaves the Earth's orbit. Whoa, that's interesting. But to simplify it for the benefit of viewers who are tuned in right now, is it a good pocket to invest in if somebody doesn't mind holding on for a first few years of uncertainty or lack of returns?
Niraj, it's very good to say that I'm a long-term investor and I want to buy this company for the next 20 years. It doesn't happen in life like that. So you buy a company, and if the Nasdaq falls 100 points, you call up your broker and you say, what's wrong with the company? So insurance companies globally. So I get this theory of how American insurance companies have made so much money, but for the first several years, you have to get your theory right. For example, insurance is basically a bet. It's a bet whether you're going to die or you're not going to die. So to get the theory right, so I can write as much of premium by giving it 10% lower than my competitor. But the risks of that will never come to you next month, because nobody dies the following month when he takes an insurance. So over the 5, 7, 10 years, you have to create a pool of reserves for yourself. You have to create a pool where you get a sense of how the market is evolving, how life expectancy actually turns out to be. And the data for that right now, if you ask me, is only with the Life Insurance Corporation of India. And that's going to blockbuster IPO, but I don't think LIC is going to grow at that rate. So globally, people have made huge amounts of. So if you have a 50-year view, I'll say if you have a 50-year view, buy a bank, buy an insurance company, split your money 50-50 these two, and buy the best of the risk managers. Because you could be running an insurance company for 50 years, for 60 years, for 70 years, and one wrong premium pricing could put you almost back to square one. So if you ask me, these insurance companies are very fashionable to talk about them, because India is an under-penetrated market, and insurance would grow because savings would grow and our per capita income would go to $2,500 and $3,000 and all that. But on an overall scale, you need to invest a lot into your reserves. You need to really plow back, and then only you can show profits. I think Birla Insurance Company, I read somewhere, Birla Sun Life, they were running this insurance business. They weren't able to show profits for the first 5, 7, 8, 10 years. And that too, I don't think we are in a position where we can actually predict what's going to happen. So if you ask me on an insurance company, if you have a 20-year view, go and buy them. I think you're going to make 15, 18% CAGR for the next 20 years. But it's easy to talk about 20 years. In a stock market, 20 years is 200 years. So I don't think that's the way to be. And plus, on an overall scale, the idea of leaving the Earth's orbit was when I wrote that, because most of the rockets that you launch, they don't leave the Earth's orbit. They come back before they leave the atmosphere. So it was in that context that we have to give it a lot of time, and then only we can invest. And these private insurers, they are 15, 20 years old. So you don't have a history for them.
Well, you also tweeted recently that growth is out of the India growth story and only a story remains. So what happens to the consumer stocks that have been moving up, quoting at high valuation, be it auto or other durables, and also the companies, the financiers who have been funding the story?
India is such a huge thing. You can find a segment and move along. But when I said that the growth has gone out, it meant that IT, pharma, PSU banks, they're all back, and there's no growth there. So obviously the consumer segment will do well, because for one company to do well, you don't need the entire economy to do well. And all kinds of markets, you will always find your pocket of companies that will do well. So I think you don't want to buy 50 companies, you don't want to buy 100 companies. Out of 4,000, 5,000 listed companies, all we want to own are the 8 to 10 companies or the 15 companies that should do well. So because of that, I think those companies will do well. But as you rightly pointed out, the valuations have gone up, but I think they're going to remain there till the time the growth continues. So, the P ratio, once it gets set, it's a 60, 40, 50, whatever. So it's like Newton's law of motion. It's like inertia. So it remains in that range unless the growth drops. So if the growth is not dropping, then the P ratio remains in that range. But the moment the growth drops, then there's a problem. So as long as the growth is there, as long as the music is on, you can keep dancing. But the moment the music stops, I think we'll have to look at the exit door.
Basant, we are almost out of time, but one quick answer on NBFCs. I know you've liked them in the past. You probably still invested in a bunch of those. Stay invested, make fresh investments, or the music
super
is off?
bullish. I remain super bullish on NBFCs. We own NBFCs, and specifically in housing finance companies, we remain super bullish.
Wow. Okay. On that bullish note, Basant Maheshwari, thank you so much for taking the time out and joining us today on BloombergQuint.